we're talking about the issues. We're talking about security, we're talking about acceptability, we're talking about at the lowest common denominator where the payments can be accepted. One of the key things is basically, yes, India is, from a global point of view, is an under-penetrated country as far as when you talk about payments that goes across. But there are forces of disruptions that are happening to change the way, basically, the way we're going to look at things happening. I'll come back to the specific issues subsequently, which has been raised in terms of the wide acceptance as well as in grocery stores and security issues. But if you look at, like, for example, from regulation, there have been large-scale changes happening in the entire landscape, right from the way there's a cost of basically doing a transaction to security and risk also. Security, for example, I don't know how many of you read the Times of India today morning, where there are talks about RBI reducing kind of security controls or values below 2,000 rupees for what they call as contactless cards, like for the kind of cards which can just tap and go for basically when you're using a metro or using something else for those sort of transactions. There are lots of several other initiatives that are happening from a regulatory side. So RBI has been very proactive in doing things. Consumers are the biggest beneficiaries and the biggest drivers of the change in anything. Over the last 6 years, we've seen electronic payments grow threefold from what they were around maybe in 2009. Now, when the whole factor behind that is, yes, the online channels or the internet has been one of the biggest driver for that. But over and aside that, a whole lot of a different population has come in, a younger population set has come in, which is willing to use cards, which is far more comfortable using cards and using that for payments, as opposed to using cash. And of course, the government has put a lot more controls on cash, so you are worried about using cash there. Technology, again, we're talking about emergence of smartphones, mobile internet, a whole lot of people, like if you look at every day's announcements coming in from people like Snapdeal to everybody else, any of these merchants, all of them are saying, oh, we're moving towards m-commerce. 70 to 80% of their commerce is happening on m-commerce. That's where the technology is evolving. We're going to see a lot more things, evolution happening on the mobile side. And of course, from a merchant side, there's a mixed breed approaches that are emerging. You have brick and mortar, like for example, the same evolution that has happened for the brokers in the financial markets. The people who were trading only in the ring earlier, people who were not looking at technology, people who are looking at only, let's say, a fixed set of terminals, have moved on from using fixed set of terminals to looking at transition as providing a pure online brokerage. For example, I'm sure you're aware about online disruptors like Zerodha and other people who are purely having an online model. So same thing applies on e-com side as well as on the broking side. And of course, you have a telesales model and other things happening out here. And from a competitive perspective, of course, excessive competition is there. There's a huge amount of competition happening in the market. Now, from a financial market perspective, or first two things. One is, from a financial market perspective, how does it basically change the landscape from an investor point of view? As an investor, today there are a whole lot of brokers' websites, the financial websites, when you look at not only financial brokers, but also basically mutual funds and all, who allow you to use your credit cards, debit cards, as well as your net banking to make payments online. For example, and this, let's say for example, we have a broker where your own broker has online payments accepted. Your limits could get changed on a real time when you're taking payments online versus when you're doing things through an NEFT or RTGS, because NEFT and RTGS go through a separate thing. Somebody else is required to do it manually out there and update that. From the financial intermediary side, if you're not offering online payments to your consumers or to your investors, you're missing out on a bigger opportunity there. There are hordes of people who are available who don't have access to, again, your NEFTs and RTGSs in your office environment. People have access to your mobile phones. People have access to the internet for doing their personal transfers. For example, if they know the broking site and everything else, but although they may not be able to get into their own net banking and other kind of options, including debit cards, because debit cards are even accepted over the internet for financial transactions also now. So if that can be used, that is a good medium for a consumer to start using and for a financial intermediary to start offering to their consumers. As much electronic payments, as much faster payments processing is there, is a lot easier. On the reverse side, including the payouts from the financial intermediaries can be made electronic. You did not go in through a physical check, because most of the things are not going to check. A lot of people are looking at NEFT or RTGS, but still there's some amount of paper remaining out there. Further to that, a lot more innovative things can be worked from the financial markets when they're rolling out products to their investors. For example, I'm not sure whether a financial intermediary can give cashbacks. So if a financial intermediary can give cashbacks, those cashbacks can be loaded on a wallet, a prepaid card which is authorized by an RBI authorized provider like Atom, and this then can be used at multiple merchant sites. For example, you can use it for shopping, you can use it for booking your tickets, you can use it for a lot more other things. So it's ultimately, I would see the transition of the financial industry also moving like a consumer industry itself, because at the end of the day, you're talking about consumers only. You're not talking about whether a person is going and buying, let's say, an electronic good, or they're going and buying, let's say, 100 shares of Infosys. They're still a consumer. And everybody is fighting for the same consumer price. So if you want to incentivize the consumer, you want to get a consumer inside, you will need to offer things which the consumer can stick on, apart from whatever value adds, because the denominator in terms of offering, let's say, your best trading, the fastest trading, the information, everything has come to, I think, stands to. Everybody is offering the same. There's no differentiation which is being offered out there. If there is additional differentiation being offered, yes, you can go on there. And I'll give you again a case study, because this is one of our customers. We're talking about Zerodha earlier, because they've been using exclusively a lot of people for making online payments only. They have a pure online broker. They don't have any fleet on street in terms of offices or anything else. Their office is only back office and nothing else, not for customer servicing and all. Customers are coming and paying, trading online only. All payments are accepted online on any given day. For them, it's a completely disintermediated structure. So from a financial market intermediary, they've gone, look at the kind of volumes. I'm sure a lot of people will be aware of the volumes they're doing right now in the markets, both in equities and commodities and multiple things. So, and they emerge as a new generation broker and with a lot of backing. And a lot of private equity investors and other people are backing such a disintermediated place. So from, when I'm coming back to summarizing the whole thing from a financial market perspective, there's a huge thing which a financial market intermediary can look at in terms of offering, when they're offering online payments and online things, and they can bundle that along with a lot more other things across there. In addition that, from a consumer standpoint, consumers have a lot to benefit also out there. As we see, if I look at from just a bit of education out here, when you look at the convergence of devices and channels, and if you look at payments, electronic payments go through multiple ways. Because when we started out, maybe around 15, 16 years back or 20 years back in terms of electronic payments, in India, I'm not talking about globally, but people started with those zip-zap machines and the point-of-sale machines where you're looking at people going and using it at restaurants and everything. Moving that to a real-time kind of a terminal which is sitting on basically a tabletop of a merchant is where is reality right now, including retail point-of-sale terminal which is integrated with the billing system. Again, my example from the financial market intermediary or financial market brokers is, why can't the same terminal be used for brokers also? For collecting payment from consumers. Yes, credit cards are not allowed, but debit cards are allowed. You're allowed to hit the account. Why can't you use the same terminal? As a person goes to a consumer home or consumer office to collect payments, they can collect payments using a debit card itself. Second channel, again, which is largely used right now, and this is the most prolific channel, because I think there's a kind of a sexiness about this whole channel. A lot of people are talking about is the internet. So internet is evolved right now. Acceptability of people going and making payments over the internet is huge. People are far more comfortable. The whole issue and worry about security consciousness is more or less disappeared. Yes, there are worries about, I think as the gentleman spoke about security risks being there. There are risks being there, but those are being mitigated by a whole lot of the banking and the financial institutions in terms of going out and looking at OTPs and a whole lot of security measures in terms of protecting the transactions. And those things are going to evolve. That doesn't mean basically you're going to stop transacting online, because compared to basically whatever you're doing, you have, I think as a consumer, if you understand your rights, you know whom to approach, you know whom to do. As long as that piece of education is there, then I think these transactions are far more secure as opposed to doing any kind of check or any kind of other transactions. And just think of it, because as a consumer, if you're looking at doing transaction, I don't know if anybody would go and stand in the queue in the railway stations to booking railway tickets. I don't know how many people of you do that. So I would assume that none of you would do that and go down and stand. And if you're doing booking train tickets online, why can't you do the same thing for something else? So that is the whole idea. Third, one of the key channels is interactive voice response. Again, a channel which has been innovated or kind of invented in India itself and been taken across globally. Today, for example, if I look at US, their volume on IVR collect-based payments model, where they collect payments over the phone call itself, is far higher than the entire e-com volume of India right now. And now the way it works is basically you have a call center agent sitting behind. Let's say, for example, I'll again give an example from the financial market point of view, because that's what the entire audience is here about. The idea is, let's say from a booking side, you have a call center agent who's picking up the phone and is saying you're transferring your margin monies on that. You can transfer money using your debit card or your account directly over the phone using your basically account number, or basically what we call there's an additional payment option called IMPS, immediate payment service, where you can put in your mobile number and what we call it mobile money ID and an OTP to do a transaction. So transaction is seamless. The way you do a transaction, even over an interactive voice response, becomes seamless and very critical for a country like India, because if you look at from an overall context, we still, when we call it, we are non-English speaking nation. We are not phenomenally an English speaking nation. Not everybody speaks English, not everybody understands English. And if you want to get a larger part of the population into the financial diaspora out here, because as the goal of everybody is, today not more than 2% of the population is actually looking at a financial market. The idea is you can, from 2%, if you shift the barometer to even 10 to 20%, that's a huge shift. And if you need to get them onto that, you need to look and talk their language. You need to make things comfortable for them. That's where things like an IVR comes in. Of course, you have mobile, which is a kind of a disruptor right now. Everybody carries a smartphone. I think as Nimish was talking just in the previous thing, everybody carries a smartphone. You have your own trading apps. You have using your market feed apps. Integrating, again, payment along with that becomes very, very key. So for example, if you're using, I don't know how many of you use Snapdeal or Flipkart apps, e-commerce apps to basically, yes, a lot of people use a ClearTrip app and travel apps, but from a broking side, how many of you use broking apps?